Welcome, everyone, to the None of Our Businesses podcast, the Roundtable Session. We are doing weekly events in business from an accountant's perspective. And with me, as always, is Charlie Zigman.
Hi, everybody.
And AJ Wheeler.
How's it going?
And I'm
Happy Friday.
Yes. And we are going to get started with this week's news. Who wants to go first?
You want to get us started, AJ?
Sure. So, let's start off our weekend wrap up here with breaking news. The PPP has more clarification. So PPP loans, this is as of, when is this? June 11th, I think this was put out. Anyway, it starts with a saying 7 modifications ago to the PPP rules ago. Anyway, they finally clarified some, I guess, like fears or some ambiguities that came out with last Friday, June 5th, finalization of those expanded PPP loan rules. And so what happened was they clarified that the 60% language that was your payroll amount has to be at least 75%. It used to be, but now 60%. But if you fall below that 60% level, it's not a cliff where all of a sudden payroll is out of the question, like it appeared to be in the first, or could be in the reading of the law that was established. It also it's weird, during the 8 or 24 week testing period. So there's an or in there. So I don't know if you choose the 8 weeks, then you're stuck to the 8 weeks, or can you switch from 8 weeks to 24 weeks? That's still unclear. And also the new thing is post June 5th awarded borrowers will get a 5-year payback period, not going back to the original loans that were issued before that. So you'll still have only a 2-year payoff period. But those are the updates. They actually say that there's some other issues that they're working on, but stay tuned, I guess. But I'd like to get your guys' input on whether this makes it any clearer, or you guys think it's still just kind of up in the air as to the rules, and we'll probably only know deadline time.
I'll tell you, like, the first thing is that I had heard about the switching from 8 to 24 weeks. This is the first I've heard of it being an option at all. I didn't know that there were, I thought it was going to be the case that everything switched from 8 to 24, and that was the change. So that if that is a change, then that's news to me.
I guess if it is an option, you wouldn't have any incentive to choose the 8-week option, would you? So de facto, even if it is,
there's no good reason for that.
Yeah. So I think the only bummer is, like, if you already got your PPP loan, which a lot of people did, then the whole 5-year payback thing is not helpful to you, right? So, and isn't it the case that you still have to apply and get your PPP loans by the end of June?
Yeah, like that? I think it is or the 1st of July or something.
Okay.
And I would almost put in another article. There's about, I think, 150 or $250 billion left in PPP funds, but everybody's so scared of it right now that they're not applying for it.
So it's June 12th, and if you have now, and the deadline to apply in the first place didn't change, so it's beginning of July or whenever that is, really then for example, the liberalization to allow for a 5-year payback really only helps those people who are going to apply in the last 3 weeks of the last few weeks of the whole loan program.
Yeah, and if you've been following anything leading up to this, it's the fact that, hey, all the people who want the PPP loan were first in line, right? They were ready to go. They weren't waiting around for further clarification. They just kind of dived in. One change I will say that I'm a big fan of in that is that I do agree that getting rid of that cliff that you were referring to that was potentially in the logic, I mean, that just makes sense. I think if, any kind of technicality or catch-all of 1%, you spent below that number, is a gotcha that shouldn't exist.
Well, and another thing I was reading in that article about the additional PPP loans that were available were banks. Another reason, even if you wanted to apply for it, banks weren't really willing to lend it because they either hit their cap in the first go, or they don't want to have to potentially have or service a 1% loan for 2 to even 5 years. They're really
Right.
pulling for these things to be forgiven. So
Right.
yeah,
Totally.
whether that money is actually available is probably even a better question, what's left to be lent.
Yeah, totally. And not to kind of steer the topic into another article, but I have an article that's kind of advocating for the other side of the equation of forgiveness. Everybody's always looking at, okay, the forgiveness has increased, and so what can we do to maximize that? I found an article in Accounting Today arguing the opposite of that, which says, is maximizing the PPP loan forgiveness really the end game? And the person who wrote this kind of takes the stance that maybe too many businesses are focusing on how they can, maximize that forgiveness and not thinking about what are some of the things that you might want to have established in place before you kind of do anything you can to get that forgiveness used up. And so some of the things you talked about were like whether or not you had enough working capital to weather the storm. It talked about whether or not the people who you were planning, if you had underpaid workers who have been partially relieved and then you're kind of paying them to sit at home, it talked about, well, are those people really even better off if they could go get better unemployment? And then you could just then use all of the PPP money for other more necessary things for your business. And so I guess I want to get your guys' take on whether or not you think there are many situations that are legitimate where a business would not want to maximize the forgiveness element of the loan.
I think one of the key things that, I think a lot of times when these articles are written about either the forgiveness of the loan or businesses not wanting to take on debt, it's because a lot of businesses don't know how to use, that kind of cost of capital or the lending correctly. It's different from a personal finance standpoint. You want to get yourself out of debt because you're not generating any revenue off of your debt unless you're smart about it, but usually you're not. And so, but for a business, your debt should be financing things that will have future value to you and bringing in revenue in the front door. So if you can invest in new machinery, new process, new product, things like that, and you have to go in debt for it, it might be a good use of capital if your cost of capital is low. And you're talking about something that has a 1% business loan basically for 2 years. So even if you said, forget it, I'm going to use it on anything I want, you can take that capital and make more money for you and only have it at a 1% interest rate and pay it back over that time period. Now, if you're a savvy business person, that might be the best thing to do. If you need working capital or you need new equipment or something like that, I think it's a very interesting case to hold on to that loan and use it that way.
Totally. And even if you're not, inflation is already greater than the 1% anyway. So even if the only thing you did was just take the money and sit on it for the entire time, theoretically, it would pan out.
Well, I think this kind of discussion came up early on, and we heard some kind of restaurant operators, for example, that were saying, look, I'm going to get the PPP loan, but I'm not actually going to spend it on payroll because my restaurant's shut down anyway. And I'm going to wait until my restaurant opens, which may not be until the fall, when we can really open in earnest with having a lot of workers and capacity. So by virtue of that, I know it's not going to be forgiven. I'm just going to hold on to this money for long-term working capital. And I think similar to what you were talking about, AJ, with like taking the money and using it as a loan, really in that way. Early on, I think there was a lot of backlash to that thought because of the certification that that and operators were having to make, which was the certification. The spirit of it was, we need this money to survive. And if you're getting it and then saying, I have it and I'm just going to put it in the bank and not use it right now, that kind of waves the flag that you don't actually need it to survive for that particular period of time, right? And so I think that was kind of the counter argument to this idea. But I think now that we've had some liberalization in the rules, I don't know what that means in the sense of, with them saying that we're not going to audit anything that's under a certain threshold and so on. Does that then, and we've got this kind of safe harbor for the certification. Does that then open the door to people blatantly just saying, yep, I got the money and I'm going to bank it for later because of those liberalizations? And yeah, I don't know. I haven't read that particular thing yet, but that's what comes to my mind on it.
Yeah, I thought it was interesting because the author kind of made the trade-off between, is this supposed to be for payroll or is this supposed to be for maximizing viability? And it seemed obvious to say, well, okay, you need viability to stay in business, so that must be the intent. But then you circle back to read the name of the program, Paycheck Protection Program, and you realize, oh wait, maybe it wasn't all about viability in the first place. Maybe it was about, you know, people's paychecks. And so, yeah, I think that's a good point.
Well, and I think it points back to what we've been saying on this podcast from the very beginning. The intent of the payroll program or the intent of the loan or how it's supposed to be used needs to be clarified in the law. And if the law is ambiguous, you're going to see people not take advantage, but use that ambiguity to their advantage. It needs to be codified. America, especially in GAP and all the way that we work, we're very rule orientated. And so if there's ambiguity in the rules, usually we're going to bend them enough to the will of how we want to use it.
Yeah, I think we see laws in taxation, other places that get written and have some ambiguity as well. So, I think it just makes me wonder, because this administration is known for saying things that could have double meanings or ambiguities otherwise. so it makes me I can't help but wonder, is there some kind of intentional confusion being sewn into into how this is done? But
I could believe that. I could be made to believe that very easily.
All right, next this is an interesting one. So, and I thought I'd just get you guys to weigh in on it, but the IRS has a rule, I guess it was issued back in 2017 over the tax overhaul that Trump initiated. And so on Friday, this is actually last Friday, June 8th, they issued guidance on tax change where there's a 21% excise tax on some nonprofit employee salaries above 1 million. So the way it works is there's a 21% excise tax on any nonprofit employee that makes over $1 million to the nonprofit. And it's not unlike this is the first time an excise tax has been levied at nonprofits, but public colleges doesn't apply to public colleges that don't have the 501c or 501 designation. So they even wrote into the law that you could revoke your 501 designation, and that could get you outed if you're a state school, any public school with state funding or whatever. And so basically what this goes after is they want to tax, and the reason this was put into the law was because they want to tax high-paid college athletic coaches. So a lot of these guys make like $4 or $9 million a year. And because it's from an organization that just hands out that money that is made by the nonprofit isn't taxed. So like Clemson University is able to deduct the tax on his $9 million salary because it's a state school, but University of Kansas's basketball team is a 501. He'll have to pay on his $4 million. So, well, the nonprofit, the university itself. And so I thought there was an interesting quote in here. It's from Phil Hackney, a law professor at University of Pittsburgh. And he says, "I've never seen anything looking and telling us exactly what Republican lawmakers were trying to do. It wouldn't seem to make sense to apply it to, say, Stanford, but not Alabama. It's kind of crazy." So basically what he's saying is that the way that it denotes public employees from either state schools but have the 501 designation versus a state school that doesn't is just crazy. So I was wondering what your guys' take on this was, and kind of, if you've heard of anything like this.
Yeah, well, that distinction between the two schools does seem a little bit arbitrary and silly, but I must say, just like hearing the intent of the law without the specifics, just the idea that maybe nonprofits should pay an excise tax when their employees are making over $1 million, I feel like that's something I could probably generally get behind to an extent. And so, yeah, I don't take issue with that. I do think picking between the schools and the type of organization that they are, especially if it can be gamed by just revoking your election, seems like not the intent of the law. Yeah, that's what I would say.
Yeah, I mean, it sounds like this wasn't necessarily the intent of it, but not-for-profits are kind of like public institutions to some extent, and public companies have had a long-standing tax rule that says that executive compensation over $1 million is not deductible for executives of a public company. which essentially serves as an excise tax through the income tax process. So for me, I think that's interesting because it kind of puts the not-for-profit on par with a public company in that regard, in terms of saying, hey, if you're paying executives over $1 million, there's a excise to pay here. That's not a normal thing, or at least if it's of a public entity that is in the public sphere, then it should have an excise tax. I mean, yeah, I like the sense of parity there for whatever reason.
I might note the article was trying to say like it kind of put these nonprofits in a pickle because they're having to account for something that they hadn't before. But I might point out, and I don't know the author, how much the author knows about like nonprofit taxes, but there is unrelated business income, which is if you have a business type activity like a church has a coffee shop or something, and it's not related to the exempt reason of the organization, then you have to actually pay business tax on that activity, and you have to file a separate form for that. And so I don't think this is too much unlike that, where or excessive compensation like this needs to be taxed. I don't see the problem there. What I do think it will do is there's a lot of, well, probably not a lot of education, but for those bigger accounting firms that deal with larger nonprofits like this, probably education-wise, is they're going to have to go after their clients and make sure they're aware of this and are tracking salaries over that amount, bifurcating them out, and making sure that they have reports that they can run on this so they can file the tax return timely, their 990s timely, so that the excise tax can be levied. And I'm sure it'll be a hefty price, just like any entity with an unrelated business income pays more for their tax return than just a regular old nonprofit. So win for our tax fellow CPAs there.
And the excise tax, AJ, it's being levied on the not-for-profit itself, right?
Yeah, the way the article reads, that's the way it sounds. It's not necessarily for because the employee still gets all the payroll taxes. You know, they're not church employees.
Okay. Yeah. I'd be curious to see, like, do any nonprofits curtail their executive comp for that, or do they just eat the cost on the not-for-profit side? In other words, do some make the executives eat some of that cost? But yeah.
It's interesting because nonprofit boards are usually like best practices. I don't know if it might be law in some states, but you have to do what's known as an executive compensation study. So your private sector you're not making far less than what a private sector person is making. So like when you're the executive director, they kind of line you up with a similar sized CEO package and what that looks like. And then they try to give, your executive director something that resembles that amount of money, so that there's not a big disparity if you work in the nonprofit sector versus working in the for-profit sector to try and attract, good recruits. And that's partly the reason why these college coaches have such high salaries, is because one person would increase a coach's salary to $1 million a year. Well, then they want the best, and so when you do these public, kind of comparisons, apples to apples, inside and outside the nonprofit world on compensation, that's how these salaries have gotten so bloated, is because one school kind of gets in a bidding war with the other on who the highest paid coach is that's winning, because these sports programs bring in so much money college football probably funds more college programs than anything else that the university does. They're bringing in millions of dollars in TV revenue, sponsorship deals with, all this stuff. It's a lot of money that goes into it, that gets brought in from athletics.
Well, and that seems like it makes a lot of sense that people who work at a nonprofit should be paid in a way that is similar to what their counterparts would make in another industry, at least to some, extent. And so that feels like something I can get behind there, generally speaking. So I've got another article we can talk about. Let's see. So it's in Accounting Today, and it's called Coronavirus May Revitalize Cryptocurrencies, but Issues Remain. And so what it's looking at is whether or not, what kind of effect coronavirus will have on the cryptocurrency market. And so it brought up some stats to kind of preface this whole thing, to say that the Federal Reserve says that cash represents about only 20% 26% of all transactions, and that half of those are under $10. And so basically people are turning to other payment methods like credit cards and like the terminals and whatnot. And Bitcoin hasn't caught on to the extent that it's, replaced any of those, of course, because it's had such volatility. It's gone from like $300 in price or less all the way up to like 20,000. And then now it's like back down to about half of that at about 10 grand right now in terms of USD per Bitcoin. One of the kind of critiques of that as a payment model or as a method of currency is that there's been really delayed guidance on how to handle the taxation of those transactions. And so what the article was looking at is apparently there's two kinds of things that can happen. There's what they call hard forks and soft forks within cryptocurrency. And so a soft fork is, I guess, where they issue new units of currency in that same, so like the Bitcoin expands so that each person who had one maybe has two or whatever, and it views that as not taxable. But it said that in hard forks, which they gave an example, like in August 2017, apparently Bitcoin released a new product called Bitcoin Cash, in which people could move their Bitcoin to that new system. And it made the ruling to say, well, if the total amount of value that you had before and after that hard fork changed, then it becomes a taxable transaction. But if the amount of value was the same as before, then it's not. And so the tricky part there is that this guidance came like 2 years after all of these events happened, and everyone who was trading in those currencies had to kind of just fly blind until this guidance came out. And so I guess I want to get you guys' take on sort of what role, who do you put the blame on when this kind of thing happens? Is it the IRS's job or any other regulator to give perfect guidance on how to handle a new and emerging market? Or is it the guy who's investing in Bitcoin who's supposed to then become a tax expert and figure out how it should be taxed? It's kind of this strange dichotomy. And so I want to get you guys' take on that.
Well, one of the things, and I had it in some postings on LinkedIn lately that I try to always remind people of, is that in the U.S. tax system, any kind of increase to your net worth, any kind of increase to your wealth whatsoever, you have to assume is taxable. I mean, that's your starting assumption. That's how the law works. So to your question, I think a lot of people are looking for kind of they're like, I need guidance as to whether this is going to be taxable or not. Well, the way our system works is the guidance is already there. It is taxable, unless what you're actually asking for is guidance that it's not taxable. And that may come, right? That may come after the fact. But absent that guidance, then the way the U.S. system works is it is taxable. So, yeah, I mean, this is interesting, getting the terminology right. It's like, okay, let me say this and see if I'm saying it right, Charlie. But if you're in a cryptocurrency and you have a hard fork and there's a change in value related to your hard fork, then now we're saying that is taxable.
Yeah, that's the stance in the article.
Yeah. And I mean, if there's a change in value, like if the value went up after the hard fork, then that's an increase to your wealth. So I would say you didn't need guidance from the IRS to know that or assume that was going to be taxable. The only thing the guidance from the IRS has done is clarified that they're not going to tell you it's not taxable, right? They're not coming back and saying, you're being your friend on this and telling you it's not taxable. That might have been nice, but they didn't do that. So you should have been assuming it was taxable from day one. It would be my answer.
I think people liked to think of it as this sort of like pretend thing so that maybe that, they don't have to deal with the ramifications of it when it grows in value. It's this sort of pretend currency that I have, it's not a real growth in my value. These are all fake digital dollars.
Right.
But the reality is that's just not the case because they have a established, conversion.
Yeah, I think, and I see that's true across the board with business owners, entrepreneurs, and taxpayers that I've worked with throughout my career. To your point, and it goes beyond cryptocurrency. It's, a lot of times people, if they don't count the value or want to count the value that they have, or the increase that they may have, if it's not in cash, there's this kind of latent assumption that, oh, if I didn't actually get cash for it, it's not real, and therefore I don't pay tax. That's not how the tax law works. It's not, not everything has to be realized in cash in order for it to be taxable. That was true before cryptocurrency was even a thing. and it's still true after cryptocurrency.
Well, and I think a lot of the people's, I don't know, their hatred towards that ruling or the way of trying to think about it differently is that a lot of them will argue that, okay, well, Bitcoin is so volatile that my wealth grew in a year and then I switched. And by the time the next year rolled around, I had already lost all my value. But if you really just focus in on the arbitrary time period of the end of the year, then by that time it looked like I was, like that person was doing great. And so I think that what you're saying totally makes sense. But I think a lot of people would try to argue that, hey, my wealth actually didn't change. It only looked like it did because we focused in on this arbitrary time period in which, that person didn't feel like they really did anything of substance some of the time because they felt like they were just moving the currency around and not, as they moved from one currency to another, for example, they felt like they were keeping it in the market. And so it's just kind of a take I've heard from people on it before.
I feel that. And I think, but that's also along the lines of, so many taxpayers who want to believe that the tax law is arguable based on reason and logic. It's not based on reason and logic. It's based on laws made up by Congress, who I don't think anyone today would argue writes laws based on reason and logic. So to start with the premise that your tax law or that whatever law is going to be applied to you, you can rationalize through it by saying, well, it only, the increase doesn't make sense to tax me because it might as well decrease. That's a very logical proposition, but to even be discussing it in those terms, you've already made the fallacy of trying to argue about taxes as if it's a logical, rational kind of thing. It's not. It's a set of rules put out by a government, and there is a thread of thought that goes through them, but trying to ascribe it as it's not like financial accounting. You can't rationalize your way through it. You just have to know the rules.
Well, and I might point out that I'm listening to the way that they're treating it. It sounds very similar to me the way that stocks are treated. You buy in, you have a basis to that stock. If your stock increases a certain amount and you sell it, then that's a taxable transaction. And then the amount that it gained is taxable. I mean, correct me if I'm wrong. That's what the hard fork sounds like. And the soft fork kind of sounds like a stock split. I mean, I don't know. I think that like if you looked at it that way, you can make a pretty good case that people probably could have seen this coming. I mean, it's just like any other capital asset, right? Like, I mean, if you put money into it, that's your basis. And then when you pull it out of that vehicle and you get cold hard money for it, then you're taxed on the difference, because you made more money.
Well, that's a good technical analogy, but I think we would have to be a little bit careful about the analogy because this will test my understanding of the rules. So I'll ask Charlie to kind of weigh in if this matches. But if you had a cryptocurrency and you just stayed in that particular currency and the value went up unrelated to a hard fork, you wouldn't have paid tax yet.
No,
just similar to having a stock. Now you have a hard fork. The hard fork itself doesn't actually cause the value to change at that point in time. The value from when you started has gone up, but the hard fork itself is not the cause of value going up on that date. There was no change in the value based on the hard fork, in other words.
They said that it can go either way. It depends on the nature of the hard fork. And it gave an example where the value of the shares went up, and it gave an example where the value of the shares went down, and it gave a different treatment for each of those values. But just to the point of whether or not of the idea of it switching to cash, making it realized, I'm not saying that I think this, but a lot of people would say that moving from one cryptocurrency to another, they don't feel that they've realized that because they feel, even though to us, we look at it and we say, okay, you definitely left one class of asset. So that was the realization, and then you move to another, and so now it's a whole new game. Some of the people who were just moving around between a couple of cryptocurrencies and never swapping to dollars would incorrectly, but they would still argue that, hey, I never realized any gain at all. I just kind of bounced around. Yeah.
Under this rule, the IRS is saying that they don't even recognize it as a realization event as long as the value doesn't change as a result of the fork, right? Is that what they said?
Well, I was kind of talking about two different things. In the value of the fork, if in the hard fork the value goes up, then they view that as a taxable event. The second thing I was talking about is just people who don't realize it to cash. So they don't sell Bitcoin for dollars. Maybe they sell Bitcoin for Dogecoin or whatever kind of other weird cryptocurrency there is. And they don't view that as a realization of the gain that they might have had, because in their eyes, they're going digital to digital, when in reality, that just doesn't matter because it's a different class of asset, and, you know, their gain was realized. So I guess I'm just sharing and I'm sharing this from arguments that I've heard from people in the past. And so I'm kind of, giving their angle on it.
I might just say, in my analogy, that would be the difference between you changing Boeing stock for 3M stock or something like that. But I guess you would have to realize it in cash to be able to then buy the other stock.
See, that's a good example, because in that example, your money maybe never left the retirement account, just moved from one stock to another. And so no real taxable event, depending on the type of retirement account, took place. But yeah.
I don't know, above my pay grade.
I don't know that I have really an opinion on it. I just wanted to share some of the different, angles that I've heard discussed on it, because I do think it's an interesting point for discussion. Yeah.
I'm sure in a couple of years, some tax lawyer or tax scholar with much more knowledge in the codification and Congress will hammer it out, and we'll have an easy flow chart in the back of some Pub 57 or something for tax law that will show us how this is done.
Yeah, and when that happens, the article even talked about that. The article goes, as soon as we figure this one out, what will cause the next issue is because they're starting to offer all these other like auxiliary products like cryptocurrency futures or retirement accounts built around cryptocurrency, and just many 100 different ways to make it more annoying, basically, is what they're playing.
All right. Speaking of cash, I got a preferred CFO article. Now, full transparency, I think this is probably like a website that kind of offers a list source for outsourced CFO services. So it's poor cash flow, how to recognize, or, cash flow, the reason 82% of small businesses fail. So surprise, surprise, they're recommending you have a competent CFO to make cash flow projections. But I thought I'd get your guys' take on basically what they're calling, how to recognize if you have a cash flow problem, and then what the solutions are for that. So they have some statistics here. So, well, first of all, how do you know if you have a cash flow problem? So this is the way they define it. If your expenses exceed your cash, then you have a cash flow problem. And I'm sure Ty and Charlie probably have something to say about that. I do too, but we'll save it for the end here. So they're asking then, is selling more, does that mean you need to sell more? And so it had an interesting kind of take from Tim Berry in an article for entrepreneur.com. And he said one of the toughest years of his company had was when he doubled sales and almost went broke. We were building things 2 months in advance and getting money from 6 months of sales 6 months later. Add growth to that, and it could be like a Trojan horse hiding a problem inside. Yes, of course you want to grow. We all want to grow our business. Cash. It's a matter of working capital. The faster you grow, the more financing you need. So they say, instead of sell, how should you address your cash flow problems? So they say, categorize your spending, benchmark, micromanage your spending, and then most importantly of all, forecast. And then they talk about how not to be overly ambitious with your forecasting. Try to use past increases in sales and know what your sales pipeline is to better detail that. And so their last kind of thing is cash flow is all about planning, analyzing, and awareness, and make sure you have an experienced CEO that knows how to do that. So I'd like to get your guys' take on it. I thought it was an interesting article to kind of kick off a discussion on cash flow forecasting.
I mean, I think first off, in terms of, I think what they're talking about, and then the terminology is right on with something that I say, is that what we're really talking about is cash flow planning. And when you use the word forecasting, it makes it sound like you're just trying to predict the weather, like you don't have control over it, right? You're just, this thing's just going down the freeway, and you're asking, what is going to happen with where I don't have any control over anything, right? Whereas cash flow planning is about, hey, here's the things that we're going to do to try to attain a certain outcome. And a forecast of what's going to happen based on your plan is part of that process. But like when we're doing that kind of work with clients, for example, at TCA, we really promote that thought process that this isn't just about forecasting like we're the weatherman or the weather per person, the weather woman. We are planning here. That's what we're trying to achieve, which is exactly what's in line with that article. And so, in terms of the planning, the term that you use that I think is really great and that I think is key to the whole thing is benchmarking, because I see so many companies that go about these kinds of endless exercises of how can we lower various categories of costs because we think they're too high. We've decided we need to save money, so we picked out these 5 categories of costs. Let's work on reducing those costs. Well, why? Because we think those costs are too high. Well, why do we think that? I mean, compared to what, right? And I think that it's a huge time suck to be spending time over analyzing categories of costs that, if you were to benchmark them, you might find out are actually comparable across your industry, right? And so really benchmarking helps you scope the problem better, right? Because you can benchmark your costs and find out, well, where are you out of line compared to the rest of your peers? Where are you different? And that it's okay to be different. Like, the other thing too is I'm not advocating that your costs should be exactly the same as your competitors or other people in your industry. You may have categories that because of your particular strategic advantage or what your strategy is, you are spending more in a certain category than maybe your peers might. Like for me, for example, I probably spend more on social media and networking expenses than your average small accounting organization would, right? Or a small CFO advisory firm probably doesn't spend what we spend on in terms of time and dollars on social media stuff, right? So, but it's integral to who we are, and so we're going to be different there. It's part of our strategy. We know it. That's fine, right? But yeah, that's one big rambling to saying benchmarking to me is the key of that, because if you don't benchmark, then you're just like shooting in the dark as to what you're trying to address in terms of saving costs.
And I know I'm being pedantic here, but I just want to hone in on what you said at the beginning, where the article's premise was having a cash flow problem is having income that is less than expenses. I just want to say that I've worked for a business that has had cash flow problems while having what I would call lots of income. And that because of the operating cycle, or because of people paying slower, because of other factors, you can look really good on paper. And I realize that the person who wrote this article wasn't referring to that, but I have to bring it up just from an accounting podcast perspective that that is very possible to have high income and still have cash flow problems.
And on the opposite note, I would point out that there are plenty of companies out there that are what I would call in the venture-backed space, where they have expenses that far exceed their income on purpose because they're building brands or they're building technology or whatever. And the whole business plan is that they've taken on a massive amount of investment in order to build those brands or build those technologies or whatever it is they're doing, with the knowledge that their expenses are going to exceed their revenues. So and they can be sitting pretty well cash flow wise because of the investment. So really the author of that article was speaking to what we would call operating cash flow, but the premise that your operating cash flow has to be healthy for the entire company's cash flow to be healthy. Yeah, in the small mom and pop business environment, yes, that's true, but not necessarily across the entire, not across the entire spectrum of possible businesses operating.
And I might say, I think the big thing to note is the fact that those businesses that have that investment kind of capital to be able to exceed expenses over revenue to build a brand, they have a business plan and a forecast, or a planning model of some kind that they know that they're going to spend this over. They've budgeted for this. They've made a plan on how they're going to do that. The good ones, at least, I should say. Not everybody does this, but the ones I think that have venture backed or have those investments, I think I would urge them to do it. But my feeling is that, especially the ones that we've worked with, they have a budget already and they know that's going to happen and they're able to plan for that.
Yeah. And so to that point that AJ just made is, from my perspective, if I were writing that article, maybe that's an article I should write. Sounds like a good one. If I were to write that article, my opening line would be more like, if you're spending money and you don't know why, you have a cash flow problem. Or if you don't know why you don't know the cause of your cash outflow, that's your cash flow problem.
Exactly right. Exactly right. And I might say that I think the reason why I read that quote is because I think for a lot of the smaller businesses out there in that mom and pop area, and I really do feel like this article was written for them, that whole kind of quote that was shared on the toughest year of a company was when he doubled sales. And I don't think young or small businesses that are new in the space understand how much cost there is around growth. A lot of times we're talking about manpower, raw materials, all those things you have to pay up front for while your product is being made to meet the demand of increased sales. So if there's ever been a cry to have an accountant around or somebody that can, plan for these kind of growth stages and be able to identify how much money it's going to cost and how much working capital and back and forth you're going to have of money, it would be that a company that's ready to grow, I think. And so if you're on the verge of growth, I urge you, and I think TCA urges you to make sure that you have, and this podcast has said it, make sure that you have a planning model of some kind, and not to be overly optimistic on sales and how much margin you're going to make.
Totally. And there's sometimes this is really insidious and kind of hidden in the details, this fact that you're referring to here. I've worked for a software company for a long time, and I know that one of the concepts we talk about a lot there is this idea called technical debt. And it's the idea that you, because of growth or because of wanting to expand, you rush through a product without maybe doing your due diligence on how it should be built. And then as a result, you maybe get through it, but you end up with problems that happen at a scale that you wouldn't have ran into had you not tried to grow so fast. And it's hard to put a dollar cost on like, okay, well, how much will it cost me if I shortcut how this process should work? But that ends up being real for a lot of businesses who rush through things. And so, yeah, I just want to say it's a really hard thing to put a cost on, but it's definitely there and needs to be considered.
And this is kind of a side note, but you brought it up, and I love the term technical debt, and I love applying it to the accounting and finance world in terms of processes, because at its essence, what technical debt speaks to in the tech world is the idea of companies using kind of brute force algorithms that may not be be able to scale as the software grows or new features are added, right? And so things weren't like elegantly put together with a comprehensive plan. And that's exactly the same thing that actually happens with growing companies, with your administrative and your accounting and finance processes, is that a lot of times things just get thrown together in a brute force way in order to get the job done. And that technical debt, so to speak, builds up to the point that at some point, you just can't scale you can't scale your finance and accounting with the operations you're trying to scale, because it's not built with good processes that were designed for that to begin with.
And we would name that accounting debt, but then everyone would think we were just talking about debt. So
right.
We don't have a name for that.
Right.
So, all right, I've got another article we can talk about that's on a whole different vein, if you guys don't mind. In the Harvard Business Review, there was an article that just reading the title just frustrated me. And so I had to share it with you guys. It was called "Want to Be More Productive? Try Doing Less." And so let me just like kind of smile for a minute to show you how I feel about that. Basically, this guy is saying, well, you really only truly focused on work 6 hours a week. So what you should do is like get out a piece of paper, draw a line down the middle, write down on one side what all your biggest wins are. And then on the other side, write all the things you do. And then try to make a connection between how the things you do lead to the things that you view as victories in your life. And then for anything on the side that you're doing that doesn't clearly correlate back to a win, just like don't do that thing anymore. And then you'll just be sort of fine, because, your paper says that these things lead to this. And so because we've made the lines, so how could it not work? And I guess my whole take on that is for one, I get a little offended at anybody who says you can only be productive 6 hours a week, because I put way too much work into that premise. I don't believe that. And the second thing is I don't like the idea that anything that doesn't have a direct connection to a victory is therefore worthless. I think that that's a pretty questionable premise. And so I want to get your guys' take. Maybe I'm just triggered by this, but what do you guys think? Is that real?
I think, I mean, it sounds like the exact kind of thing I would totally buy into. Like I'd be like getting out my piece of paper, trying to figure out how I can make that work. I mean, I'm always into those kind of things. But I mean, yeah, I get your frustration knowing who you are and kind of your work ethic and everything. And I'm just laughing about 6 hours a week. I mean, even 6 hours a day would be laughable to Charlie. So I think, I think that, I think though it's interesting because I think there's people do all kinds of different work too, right? And I think that from the kind of work that we do we do a lot of small things that add up to bigger things, and it might be difficult to trace all those small things into kind of the final big outcome of what it is. But every small thing we do is important in adding up to the bigger thing that happens. I think it's possible. I can imagine. I've never had this life, but I can imagine that there might be people out there that spend 90% of their work week doing bullshit, and 10% or less doing something that actually matters, and that they actually earn a full-time living doing that. And I think people in the consulting kind of, particularly in the accounting world, we have a hard time relating to that idea because that's just not the accounting world, right? But I do scratch my head, having not been on that side of the fence, wondering, when you look at other disciplines and other kinds of executives and other kinds of leaders and some of the things they do, if maybe there is such a thing out there. I don't know. I'm always hopeful. So maybe I'm less offended and more hopeful that there is such a world where somebody like that could exist, that this kind of thing might work.
Ty, I was a staff accountant at a public accounting firm. So 90% of what I did was nonsense and bullshit. And then the 10% at the end was what mattered. No, I'm only joking. Well, I think what I thought about when I kind of skimmed through this article was, I thought, you need to know yourself. And I know that sounds like so hippy dippy or Gary Vee style or whatever, but I think you need to know how you best work. And I think that differs from person to person. I can use myself as an example. I can go a good 3 or 4 hours strong on a project, and then I need to step back for 15, 20, 30 minutes and take a break. And then I can go back and I can either start a new project or return to the project that I was at, of course, reach a stopping point and continue for another 3 or 4 hours at that project. And about at the 8 to 10 hour mark of work combined, that's about when my mind is not all on task and I need to step away for a good amount of time, and I need a day of kind of downtime during the week to be able to reset. But that's just me, and that's my personal thing. There are many people like a Gary Vee or something that probably work 12 hours a day, and like all the different things they do, and they're able to continually have the mind running or whatever. But I just know for myself, and I had to come to that really, I often tried to buckle down and power through a 12-hour day or something like that. And what I found was my productivity was far less when I didn't take those, in not knowing myself and just thinking oh, the guy next to me is doing that, I have to do that. And it wasn't until I realized myself that I became more efficient, and my work was, the outcome of my work was better because I knew myself and was able to step back and adjust that. So I don't know.
And I want to say, I do agree with that completely. I think that sounds right to me. I too get burned out if I've been sitting there for 4 hours and I need a reset. And so I think that's true 100%. I just question the ratio. Just what is the right ratio? Because I'm with you. I mean, if you work an 8-hour day, or if you work 4 hours and need 30 minutes to break, and that, to me, that's a totally reasonable ratio. If it's you work 40 hours a week and you only find 6, then I think that's where it starts to get a little more iffy. But, like Ty said, it depends on the industry. I'll say I've worked in a few different industries and I never found one. None of the jobs I ever had really had a lot of downtime. I worked at places where there was just constant work always. And so I just kind of got used to that. But I think it maybe makes a lot more sense if in those environments, if there is, more downtime.
I might step in there because I've had a lot of different jobs in my working experience, and I've worked remedial jobs from digging ditches to working at a call center to delivering pizzas to being in construction and owning your own business to being an accountant. So I've had a lot of different industries. Worked in the auto and tint industry for a while, And I can't think of any of them that didn't, you weren't doing something during your time, like in the restaurant industry, if you have time to lean, you have time to clean, and that probably goes for the construction industry too, that there's always something to do. And especially when you're in like, a kind of I don't want to say remedial job, but like a labor job of some kind, working in the food industry or something, there's always something that can be done. And, the brain power required to do so, it's not a real cerebral job. It's labor, or it's setting forward. Construction may be different. There's math and building codes and all that stuff behind it, but at the end of the day, you're putting 2x4s up, or you're laying tile or something like that. The cerebral part is outside of the manual part of laying tile or something. So I think but I've never been in like a marketing position where you think about ideas and come up with content, or something like that. So I don't necessarily know. Maybe you do kind of, for lack of a better word, fuck around for 60 hours a week writing material that is considered not working. And then for 6 hours a week, you film a TV show or something. So I don't know, I guess there could be one out there, but I've never experienced one, because I probably would have stayed in it. The article that I was pulled, my last one for the week, is this one's from Bloomberg. And I thought it was really interesting before I even knew that this was a Portland business. So for our viewers that don't know, we're based out of Portland, Oregon. And the title of the article is How an Online Yarn Seller Kept Dozens of Businesses Alive. And to save small businesses affected by the coronavirus, Brooklyn Tweed, which is a Portland company, developed an unusual stimulus plan. So this is actually a stimulus plan that they came up with at the onset of the coronavirus to not only help themselves drive business, but also to help everybody down on the list, people that bought yarn from them, small mom and pop stores, and then also like their suppliers, to keep their suppliers in business as well. So they said the payoff was from March 15th through May 15th, they pumped about more than $300,000 in store credits to more than 100 retailers, mostly in the U.S., through what it called its Apart Together program. And so what this Apart Together program was, they wanted to drive you to either to buy their products from one of the people that stock their products on a different website. So a different yarn store, like if your local yarn store had this Brooklyn Tweed yarn and you bought it from that store, you were able to take a discount on your purchase, and then that would be then refunded to the company that you bought it from. Or if, say, you were a small mom and pop yarn business that was selling their yarn, but didn't have a website, what Brooklyn Tweed allowed you to do was to buy directly from Brooklyn Tweed's website, choose the amount of your discount again, either 5 or 10, 15 or 30% off, and then that amount of money would go back, and then you would designate the mom and pop store, a yarn store that you wanted to go back. And so what they did was they basically didn't make any of the stores track all this. They did it on the honor system, thinking that this was a good idea. And I thought the best part of the article said that they researched other initiatives, but they also were in close contact with their accountants to realize how to do this. And so I thought I'd get your guys' take. I thought it was a really cool story and a really cool kind of way that they kind of use their position in the market to be able to do this. A little bit about, before we get in, a little bit about Brooklyn Tweed. It's been in Portland in business for 10 years. They're U.S. produced yarn. Everything they do is done in the U.S. And they have 10 employees. They do about 1.5 to 2.5 mil in revenue. And so, yeah, I'd like your guys' take on this kind of unique stimulus package.
I think it sounds really interesting. I think anytime you have the honor system in play, you got to be a little careful with that. And maybe it's a good, maybe a commercial for internal controls, or developing some kind of system to track or test that. But I think it's a really good thing that they're doing. And I think the world needs more businesses like that.
I don't have anything on that.
I was kind of hoping you guys would weigh in on how you think the accounting treatment was done for that. You'd have to probably set up a liability, right, for these amounts going out. So you would I guess, how would you estimate that? They said they were in contact with their accountants, and you didn't really have a cap on it, I guess. What's the accounting treatment there? How would you handle that if one of your clients came in and asked you, we want to set up this program?
So the retailers, what do they have to do to get the credit again?
Well, it depends on how they did it, right? So if the yarn was bought through the website of the local mom and pop store, not Brooklyn Tweed, then that discount, they just forward it on. They just tell them how much the discount was that they gave it, and Brooklyn Tweed took that right off the top of what they owed them. You know, so to the cost of the yarn that they were selling or whatever. If it was done through the Brooklyn Tweed website, then they would send, they kind of bookmarked who that money was earmarked for, and they sent that as a credit to their AP bill to those local mom and pops. It was that didn't have a website, or they denoted a mom and pop store that did, but bought it through the Brooklyn Tweed website. Then they would send that money, or earmark it or put it a credit against the AP, I guess is the way that I read it. They didn't necessarily get into the nitty gritty, but that then was offsetting a bill probably, or they might have just refunded the money to them.
I see. I think it's definitely an innovative. I guess producers have come up with incentive programs for their retailers. Is not an uncommon thing, right? That is something that's already there. So to me, this seems like it's like what's unique about this or different about this is just the way in which it's being administered. In terms of the accounting of it, though, I guess, yeah, you don't know. You don't know. You don't know ahead of time what the discount that the yarn store is going to give a knitter. So that's your problem.
Yeah.
Yeah. You would have to estimate, I guess. Would be if the issue is that you're going to be giving these discounts that are of an unknown amount by credits, you would have to. That means that your sale, you don't know what the final amount realized on each sale is until that whole thing is worked through. So I don't know the technical answer to that, but it seems like you've got two possible issues. One is two possible things. One would be the old, okay, we just estimate what the amount would be based on our best guess, and we book a contra account for that estimate against the revenue. The other possibility is that you hold the revenue open until the discount is known. You basically say, well, if we don't even know what we're going to realize on this revenue, then we don't recognize any of it. I suspect they're not doing that. I bet they are recognizing their revenue and at most maybe booking some kind of reserve against it based on an estimate.
Or I guess there's a third option, right? Like if you don't care about month to month like financials and you're just on a calendar year taxpayer, then because this is in the middle of the fiscal year, you just wait until it's all done and then figure it out at that point.
That's what I say.
Right. Or you book the sale at the full amount, and then when you have to give a discount, you just book that as a separate expense when it happens, and you're done, right? I think that could lead to all kinds of funky management reporting problems, right? Because because in terms of the way these discounts are offered, they're offered as credits back that could be used against future invoices as well, right? So you can imagine if the company's policy is to just don't account for anything until it actually happens, say in cash, then that could mean that you basically discounted one invoice. You record the invoice up front at full price, you discount it, but it doesn't get recognized there because the discount shows up a credit on the next invoice. So the next invoice, you actually just show it as a sale for a lower amount or something, right? So now you don't really have a real accounting for what you were selling on a by item basis. But yeah, this is a small business altogether, right? Even every player in this, it's kind of funny to talk about this as a distribution chain, right? Because you're talking about a producer who makes the yarn store who buys it and then sells it to knitters, and then the knitters themselves, who are some kind of small business probably, that buy the yarn and they knit their things and then go sell them on Etsy or whatever, right?
Well, it's also a B2B kind of operation, right? They sell to other knitting stores.
Yeah. But every business in the chain is a small business. That's what's kind of interesting about it, right? Because a lot of times when you see these chains, let's see, I actually got the article here. Annual revenue ranges for the producer, the annual revenue ranges only from 1.5 to 2.5. I don't mean only to disparage that, but that's a small business for sure, right? And so, yeah, I guess my point on that is it's interesting because I'm trying to, I don't know that I've even seen that kind of dynamic before where you have the producer, the distributor or the retailer, and then another business on the other end, and they're all small businesses, right? I mean, typically what you see is a producer who actually is a pretty big business, and then you got like maybe some small businesses that are working with that, but everybody in the distribution chain here is a small business. So that's a fascinating dynamic, which maybe plays into how they're able to make this work, right? In terms of, as I said, on the honor system of people selecting kind of where they got their discounts and all that. But
I'm not sure the like technical answer, but I think that the real world application answer that I've seen in practice is to just kind of go ahead and do it, wait 2 years, and then call us to come in there, clean it up because it was all done wrong in the first place.
Right. That's exactly right. Yeah.
It's a good plan.
That's it. Yeah.
It's a pretty good plan.
That is how you do it. Yeah.
Yeah. I've seen it work.
Yeah.
I don't have like a real one. I have like a fun one if we can just kind of like talk about something stupid for a second.
We've never done that before.
Yeah. Never on this podcast. I'm all done with my whiskey, so go for it. Let's go.
Yeah.
Well, so I've been working with some legal clients, and so I've been kind of getting more into maybe some law cases and stuff. And then I'm a big fan of Wikipedia. And so one of my favorite things to do is I'll like go read the Wikipedia. There's like a place where people will post the articles and then kind of vote on what's the most interesting one. And so one of the ones that came up was a court case that took place in 1976 entitled United States versus article consisting of 50,000 cardboard boxes, more or less, each containing one pair of clacker balls. And so what it is, and so what it is actually there's, I gotta find the name of it, but basically there's most cases that you hear about are against people, but there are also cases against an object. And so what happened was this shipment of 50,000 of these like kids toys like showed up, and the US government like basically seized it because it wasn't clear on whose it was. And so part of the civil forfeiture process is that they have to then post an article in a newspaper saying that we've taken this thing and that we're going to destroy it. And they had even like cited some of the dangers that these little clacker balls had, posed for little kids. And so there's this other guy who owns like a novelty store, and he like sees this. And so he writes in and is like, hey, those are mine. And they're like, well, you prove it. And he couldn't. And then they were like, so then there was a case where he was trying to say that their grounds for taking these clacker balls were not okay, and he was going to get them back. And it went back and forth on a bunch of different appeals. Ultimately, the government decided, no, these are dangerous clacker balls. We're going to get them out of here, and that they granted him the right to go ahead and destroy it. But the reason I brought it up is I just love this idea of a guy who runs a novelty store, and he's just like sitting there flipping through the paper, and one day he like sees this article of like 50,000 of his, not his, but just like novelty toys that are just like up for grabs. And I'm just picturing this guy like calling his wife, like, get in here, honey. You're not going to believe this. They found 50,000 clacker balls, and then ensuing this major legal battle to like chase these clacker balls, and then not getting them at all. And so I
maybe you said it, but for everyone who's watching, what is a clacker ball?
I'll show you a picture. It's like a little toy, but it's just two little balls with a little string, and the kids can kind of spin them around. It kind of looks like cherries. Here's a kid with one. Cherries or truck nuts, for depending on our demographic. I know this is not real high tech kind of thing, but yeah, it's just like a little kid. And the argument was, they're pretty dangerous. Kids can swing them all around and hit each other or whatever. Yeah. But like at the same time, they were going to enter the country okay. Before that, they weren't banned.
There we go.
No, there we go.
I have never seen that before. Yeah. I remember I had the one that was like the wooden hammer that with the scoop on the end that the ball could sit in.
Ball in a cup.
Yeah. Okay.
What else did you call that?
This is what I thought of when you said clacker ball. This
Yeah.
thing. Oh, great. Oh, yeah.
Oh yeah, it is. It's a mini clacker.
Yeah.
Oh, okay, there we go.
And you see
Turn
how
up the
dangerous
volume.
I mean, that anything could happen once you start getting one of the, and 50,000 of those in a room, anything could happen.
Yeah.
I'm just saying, like, nothing's for free. This guy probably thought free inventory and then went after this court case, and he probably paid a shit ton of money not to get his clacker balls.
Yep.
And I think I've said balls too many times in one episode, so.
I just also love that it's like 50,000 more or less. They're the kind of right in the title. They're just like, does it really matter how many clacker balls there are? It was a lot. Trust us,
It might be noted, Warren Buffett, he owns Oriental Trading Company, and all they sell are like little trinket stuffs, and he made a bunch of money off of buying them. So there is money to be made in the novelty fun factor Dollar Tree shit. I don't know.
Yeah. Totally, especially because these things cost nothing to produce. I mean, we're talking about little pieces of plastic that definitely, are made on the cheap.
All right. My mom used to run a clown business, dude. I used to be a professional clown when I was younger. Have we talked about this before? Have I told you this story?
Well, a little bit.
I knew you were a professional clown. I don't know if I know this story.
Yeah. So she used to order all kinds of, for like party bags and shit. We used to order from Oriental Trading Company. And you're right, man. Like those clacker balls and shit, they're like pennies, like two cents a piece or something, and you get like 50,000 of them or whatever. Yeah.
Totally.
I don't know.
That's weird. Yeah, it's weird because you have to imagine that the individual parts probably cost more than that actually if they're sourced in the US, for example. But
yeah, I don't know. Probably all from China.
Yeah, that's right.
It was all from China, and it's definitely all just like very, the trashiest plastic you can find and whatever.
Made with stuff that gives you cancer.
Yeah, totally.
I worked in a plastic molding injection line for like a week, and that shit's for the birds, man. It was kind of crazy, dude. You get all these like chips of plastic, and they get like pushed in and melted, and then they get like glopped in to make like Ford light covers and shit, and like the Barbie Playtime microscopes and shit. This is all unusable. Now we're just shooting this shit.
Yeah.
We're gonna have a blooper reel like eventually. All right, everybody. This has been the None of Our Businesses podcast. Thanks for joining us, and come back again next week for more on what's going on in the world of business. Thanks again.
See you, everybody.
See you.